Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward, and we've got a special treat, a special guest here today, Chuck Carnevale. Chuck is the creator of FastGraphs. Every week, we break open different stocks, and we utilize FastGraphs quite a bit. Chuck created FastGraphs. And by the way, Chuck is also a very good friend and also a mentor to me as well as Nick Ward, where we met years ago on Seeking Alpha. And so, Nick, it's good to see you. And Chuck, thanks for being on the show today.
My pleasure, guys. Welcome. Glad to be here. And congratulations on your channel, by the way. It's looking good.
Yeah, well, thanks. This is like the gang getting back together. We launched Dividend Kings years ago, and now here we are on YouTube. So, it's funny how the world turns.
Small world.
Well, Chuck, your nickname, of course, is Mr. Valuation. So obviously, as I mentioned, you taught Nick and I both a lot about valuation, principles of valuation at a high level. Can you explain why valuation is so important when it comes to investing?
Yeah, thanks, Brad. They do call me Mr. Valuation because I'm very passionate about it. In my worldview, all investing, if you're going to call it investing, is really value investing. If you get outside of value investing, then I believe you're entering the realm of speculation or even, to an extreme gambling. So the whole concept of value investing, though, is often misunderstood. Value investing implies in only being willing to, and by the way, I'm only going to talk about value investing as it applies to stocks, obviously, which is what our channel is all about. But value investing implies positioning yourself. Well, let me back up. You find a company you really like, and we've got 5 or 6 here that are going to be interesting to look at in a minute. And the key is you love the business, you love the management, you love, the consistency of its fundamentals, its dividends, and how, consistently they've paid them or whatever the case may be. But that's one step in the process. It's not enough just to identify the great company. You got to make sure that you're investing in it where you can position yourself to fully participate in whatever kind of operating results the company can achieve. And one thing that's misunderstood, value investing doesn't ensure a high rate of return. It ensures a prudent positioning of your money into a company if you understand what the company delivers. If it's an income stock, it may be a great income vehicle. If it's a growth stock, it may be a great growth vehicle. Sometimes it can be a combination of both. But in the long run, as you and I, Brad, have talked about, Nick, so many times, earnings determine or drive market price in the long run. In the short run, emotions will drive market price, and that's primarily fear and greed. So the idea here is to identify the right company, the company that you admire and want to invest in, and then make sure that you're investing in that company where you're going to be able to fully participate in the growth. If you overpay, a company can do great, and your returns could be poor because you paid too much. In contrast, if you can get an opportunity to buy a company below its intrinsic value, and we're really talking about intrinsic value here, then you can actually leverage your returns and actually make more money than the company delivers because you bought it at a good value. But at the end of the day, it comes down to assessing risk and investing at a risk level that is comfortable for, whatever the investor's goals, objectives, and risk tolerances are.
Great. Well, thank you for that overview, Chuck. And again, it's just an honor to be on the show with you. And I remember when I first started on Seeking Alpha, like in 2010, that's where we met. And now it's been over 15 years.
Wow. Time flies, huh?
It's amazing. But today we're going to focus on 6 companies, 6 stocks, Chuck. And I wanted to do these, what you've often referred to as analyze out loud, utilizing FastGraphs. And for those of you who don't know, FastGraphs stands for Fundamental Analysis Software Tool. So Chuck is going to be really highlighting fundamentals for each of these companies, and of course, valuation as well, to see where those intersect and where the good opportunities. So we selected 6 companies, and I let Nick kind of dive in a couple of these that he's most familiar with. So Nick, I'm going to let you get started.
Yeah, I'll go one at a time here, and based upon what's on Chuck's screen. So I see Adobe at the top, so we can start with Adobe. This is a software stock that we've talked about several times recently on our channel because today and after its recent sell-off, Adobe's trading at levels that we haven't seen in more than a decade. So, Chuck, I'm just interested in what you have to think about this. to me, I look at this chart fundamentally. The stock looks cheap. We're at 18 times. If 17 times forward, the stock's growing at 12%. That's what analysts are predicting. My question with a stock like this, and really what I was interested in what you had to say is, one, obviously, do you think it's good value? But two, the issue with Adobe is people think AI is a potential disruptor here. And I know we're not going to get into the business, but how do you factor in kind of fears like that? Maybe not trusting the analyst estimates looking ahead. When you look at a company, do you just take it? This is a widely covered company. I think there's 25 or 30 analysts, coming up with this consensus, but there's obviously some fear that consensus is not going to come to fruition. So that's my question. That's kind of what's held me back personally from Adobe during this sell-off. I'm a little scared about what AI is going to do. So interested to see what you have to think about this company and how you kind of think about, future threats when looking at fundamentals in the present.
Yeah, that's excellent. And, this is a very interesting company, and it's a classic example, in my opinion, now, is Mr. Valuation. Now, one thing about it, I'm very, very disciplined. I think, as you guys know, about valuation. But to me, the primary factor that determines valuation is earnings yield. Okay. And I actually think Adobe is still an overvalued stock. And I think it has been. I think it's a great company. I think it's a great stock. It's A+ rated. It has very modest debt to capital, less than 36% debt to capital. And as you look here at the string, I'll take price off the graph just to give us a real fundamental look. This company's put together an almost impeccable string of earnings growth, and it's averaged on this time frame I'm measuring about 15%, and that's spectacular. Very few companies can boast a consistent 15% growth rate like that. If you shorten the time frame, they've actually accelerated their growth rate. And I'm looking from, and by the way, they have a November fiscal year. That's something that FastGraphs immediately shows you. So you can see the triangle here is like 1 month before the calendar year end. So the company has really strung together some really impressive earnings. Now, when you look at the price, when you add weekly closing stock prices, and you look at these growth rates, you had 60% growth, 40% growth, 40% growth, 57% growth. Then along came COVID, and the growth rate dropped to 16%. And then if you would call this a disappointment, I think the company disappointed because no longer was it growing at 40 and 50%. All of a sudden now it's growing at 28%, then 10%, then 17%. And as you pointed out, Nick, it is forecast to grow at approximately 12%. I think the actual number is 11.66 currently. And by the way, that growth has actually been increasing ever so slightly. 6 months ago, analysts were forecasting $20.40 for this fiscal year end. Now they're forecasting $20.62. So that's a positive. The company has an impeccable scorecard, in my opinion, which, the only time they really missed estimates, I think, was during COVID. Otherwise, they've either green means they, met estimates, purple means they beat estimates, and red would be where they had a miss. And that was with a 10% margin of error on a 1-year forward estimate and a 20% margin of error in a 2-year. So the company's got all the attributes that I look for in an investment. My only concern with it is valuation. Now, the company has kind of switched to a subscription model recently. I'm not sure the exact date of when that happened. And that could be part of the reason why we see this volatility in the stock price. And of course, you can see that, something I like to point out, one of the more predictable lines on the graph is the operating results here. The company is just continuously growing earnings. And they were growing at extremely high rates. That growth rate has slowed down now, but yet double-digit growth is still considered very strong growth. So I want to say that, and kudos. But you can learn from the past, and you got to be careful not buying a company based on its reputation. Its forward growth at 12%, it's kind of entering. If you'll notice on our forecasting calculators, we have 5 orange lines, 1 dark one, and then 2 above and 2 below. And these are parallel lines, I want you to notice. So this company is in the area of, value. But here's the rub. If you went out here and this stock traded at a 15 multiple, which I would consider a fair intrinsic value multiple for a company growing at 12%, then you don't really have much in the way of rate of return. You only have a 1.7 annualized rate of return, assuming the company's PE ratio shrunk from its current 18 blended PE, 18.68 to 15. But if you were looking at the normal multiple, and I really want to talk about this a lot, the market's been averaging about a 38 PE on this company. Now here's the problem. That a 38 PE would imply an earnings yield of about 2%, 2.5%. You simply divide 1 by 38. Maybe one of you guys can do the math for me and tell me what that number is. So I want to put that into perspective. This is why earnings yield is so important. Let's assume you were richer than Elon Musk. Okay. Let's assume that you were a multi-billionaire. Now, this company has a current market cap of $157 billion. So it's a very expensive company, or a very highly valued company. But here's the point. If you had $157 billion to invest, and you decided you were going to buy 100% of Adobe, and this is where earnings yield really impresses today. So I'm going to, I've got the money. I'm willing to pay 157 billion to buy 100% of this company. My yield on investment would be less than 3%. Now,
Yeah, you're at 2.6. I did the math for you, Chuck. 2.6%.
2.6%. So, would you be willing to invest that kind of money with a return of 2.6%?
Yeah, and that's at that 38 times, historical
that's at that 38 multiple,
yeah.
Exactly.
Mm-hmm.
Now, at a 17 multiple, the earnings yield is 5.35%. Now, my threshold for any company growing less than 15% a year is a 6.67% multiple, which is 15 PE. And by the way, these numbers, these valuation metrics are always derived, or they're derived as a form of discounted cash flow analysis, which I think Brad will talk about that even with real estate. It's always, value comes from how much cash flow a business is able to generate on behalf of their stakeholders. So, what the willingness to pay these high multiples for Adobe was based on the fact that the market was willing to do that. But you can see by the results of the price volatility here that was a very risky enterprise. I mean, if you look at this mountain chart of stocks here, I mean, the roller coaster ride here was absolutely incredible. Now, again, take price off the graph. You got one of the finest companies you could ever look at. And by the way, I'm going to get a little deeper in the analysis. I'm going to move quickly. So my problem is right now a 5% earnings yield. And you're right, Nick, I should have corrected that. The 38 multiple, assuming the 38 multiple is, in my view, very, very optimistic. Now, assuming and buying it at an 18 multiple gives you a 5% earnings yield, that's getting a little reasonable. Keep in mind, the average rate of return on stocks is averaged between 6 and 8% over 200 years. Sometimes it's 15%, sometimes it's minus 5%, depending on the markets and the valuations. But in general, stocks give you a return of 6 to 8%. So from a value investor's point of view, I'm looking to really position myself for the stock, where I'm able to buy the whole company and pretend to, because really earnings yield is the same as dividend yield. It's just 100% payout ratio. That's what it boils down to. So looking at it going forward, I like it a lot. Now, what I would do with a company like this, though, is I would put this on a watch list. Me. Now, you guys may be, again, it comes down to how much risk you're willing to take. I'd put it on a watch list. If this thing came down to a 15 PE, then I would be very motivated to buy it. I'm motivated to say it's not a bad buy at an 18 PE, because let me show you how that would work. If you invested that at 18 PE and it stayed at an 18 PE, you can make about 10% a year. But if it did revert to the ultimate mean, which is 15, you'd only make less than 2%. And just looking at the graph historically and putting the weekly closing prices on the graph, I want you to see that traditionally, and this is a 15.67 multiple that's this particular time frame is being drawn at. You can see it was trading at multiples like that. But you could bought it at an 18 PE, even a 24 PE. And now at this level, you would have still made a very attractive rate of return. So I want to be clear about that. You almost can't overpay for a company that grows a lot. Okay, but what you do is if you pay too much, you minimize or lower your rate of return, because here's a 13.65% return had you bought it on July 18th of 2008. On the other hand, if you'd have waited till January of 09, just 6-7 months later, let's say, and bought it then, when valuation was really in line, your rate of return goes up to 18%. Now, if people understand the power of compounding, the difference between 13% and 8% is not 6%. It's like doubles or triples the amount of money you would make. Well,
it's
here,
millions of dollars.
Yeah,
People.
exactly. So, as I like to say, and I say it endlessly, valuation matters, and it matters a lot. But what I would do in a company like this, then, I would go into fiscal fitness. What I'm looking for is, why did the company's stock price become so volatile and drop so much recently? So a lot of what I like to look at, for example, one of the first places I like to look is at margins. Is there anything in margins? Now, this company has maintained very consistent gross margins at very high level, 80 some percent. Operating margin has been a little less consistent, but in recent years, and I'm always more focused on the last 5 or 6 years than I am the last 20 years. Okay, margins have held up. Now, this could be spooking the market, and again, that's an assumption. That's not a fact. Okay, because we've seen margins, net margins, dropping over the last 4 or 5 years, but they're still quite healthy. So that, this isn't, now there's a lot of companies that cut their right arms to have a 26% or 25% net margin, which Adobe has. So this is a terrific company. It's trading at a valuation, and we've added a metric here. I don't know if you guys are aware of it. If you go down here and look at the bottom here, we have the current valuation. It'll draw a line through the current price and then give you kind of a barometer, if you will, of how often the company has traded this low a valuation. And to the credit of you saying it looks fairly valued earlier, Nick, and I don't disagree with that, it was only during these times coming out of the Great Recession, which remember, this was a period of pessimism. We're now in a bull market. And so, we haven't been able to buy Adobe at this level. But the question is, are you buying it at a true value? I think you're overpaying for the stock if you buy it today. Now, it's down today, if I'm not mistaken. You can also go into external links on FastGraphs. And
I think it's down another 1.5% or something right now.
So, we won't bother going into that. So, if you could get it cheaper, I'd be all over it. But I think you could probably buy it here, and maybe a 15 or 20, or say a 20 multiple would not be out of the question. A 38 multiple, in other words, using the normal multiple, I think is just pipe dream.
Yeah, no, I think we agree on that, all three. I'm not interested in paying 38 times for Adobe. I think 18 times is interesting because, like you said, it hasn't traded at the 15 times that you would love to see, except for in that kind of post-Great Recession period of pessimism. But for patient investors, like you are, if you wait for that, if it hits, you're going to make a ton of money, I think. So
now here's one thing that I am a little concerned about. This is buybacks. Okay, so as you can see from this is diluted shares outstanding. Okay, so it's share buybacks. So they went from 612. How would you read that, guy? 6 billion shares.
Yeah, a lot of shares.
2006, all the way down to something like 448. In other words, this is they've been buying stock back at a very high rate. Now, my problem with that, I like share buybacks or I hate them, depending. And the reason I hate them is when a company is buying back their stock when the valuation is very high. Mm-hmm. To me, what that means is management is positioning themselves to destroy shareholder capital because they're going to invest all this shareholder money. If they're buying the stock when I wouldn't buy it, I consider that a red flag. But having said all that, I agree with you, Nick. This is a company I don't consider it cheap, but I do consider it a lot better value than it historically has been. And there's something to say about a stock because if you exclude the post-recessionary years here, out of 08 and 09, it has always commanded a reasonably high valuation, but it also did it with much higher levels of growth than it's expected to do going forward. So you got to be expecting that judgment. So to be safe, you want to buy it at the lowest valuation possible. But I think that's enough on Adobe.
Yeah, no, Chuck, that's great. And we're so Brad, I'm going to cut it down to 2 picks because that is Chuck's breaking these things down in a lot of detail. I'm sure our listeners are loving this. I'm loving it myself. So Chuck, I'm going to give you one, and I think that this meets your earnings yield. So I'm excited to hear what you have to say. This is a stock I've been trading in the past couple of weeks. It doesn't pay a dividend, so it's not necessarily something I love to own, but I've been kind of generating income using options, selling like cash secured.
Am I guessing correctly, Nick?
Yes, sir. Yes, you are. Yeah, that one, it sold off 20% last week on earnings. It got to a level, I loved it. And so I feel very comfortable with the risk. Selling options contracts, if it, trades below the point where I sell it, I have to buy the shares. That's how that works. I was selling at, I think, 140. I felt very comfortable owning this company at 140 if push came to shove there. So yeah, I'm interested to see what you have to say about that. And this company's down, but like you said, the fundamentals to me look like they're still holding in really strong.
Exactly. And by the way, I'm going to add, this is, I spent I've sort of morphed at my golden years here, we'll call them. I've morphed into a dividend growth investor. That when I was younger and full of what and vinegar, I was more of a growth manager. I spent most of my career as a growth manager. And growth stocks were, what I always loved. And Fiserv is a quintessential example. Any company that can generate above 15% growth as consistently as this company has is a growth stock, in my opinion. Now, there's a couple other lessons to be learned here also. If you look at market history coming into the recession, this stock really held up better than most. What I think I really want to point out is this was the worst recession since the Great Depression. All right. This stock's earnings grew during that period of time. They grew at 5% in 07, one of their worst years, but they still grew. Okay. They didn't collapse. Then they grew at 24% in 08, then 11% in 09, 11%, and then they start accelerating the growth again, and then we start getting these years. So, the devil's always in the details, but this is a phenomenal company, and this is one of the best valuations I've ever seen. Now, looking at it from a forecasting point of view, analysts are still expecting the normal 15 to 20% growth. They're actually expecting this. Now, this is from FactSet, and they're, like Nick pointed out before, there are 32 analysts, and estimates have been holding pretty much the same. They've varied by a couple of pennies here. 6 months ago it was 1021, then it was 1023, then they went down to 1020, and that's what they're currently estimating. But keep in mind, this is a transaction and payment services company. If you look at this industry, look at global payments, look at Corpay, look at many stocks in the industry, this stock has held up better than most of them. Some of them are just trading at ridiculous valuations, but you can't get a more impeccable quality company than this one, in my opinion. They have a little bit, I like less than 50% debt in a growth stock, but if I look at this company from a standpoint of cash flows, and I usually do that with dividend stocks, but just looking at operating cash flow, their operating cash flow has been very, very strong, growing at over 13% a year. If I look at their top line real quick, their sales have consistently grown at about 10% a year, and it's averaged about a 3.5 price to sales ratio. It's currently just a tad over that, but that doesn't alarm me. I think this stock is extremely inexpensive now. The company still has really strong fundamentals, and so I think this is a buy. But here's the point I wanted to make. When you look at a stock like this, one of the worst things about value investing that I think people have to, maybe Adam has to give me permission or something I'm not able to share. But bottom line is, when stocks are dropping like Fiserv, you got to realize that in a major bull market like we're in today, you're not going to find even high quality stocks like Fiserv at fair value unless there's some problem somewhere. And that's one of our jobs, is to try to figure out what the problem is.
No, I think that's good. Yeah, that's the problem, I think, Chuck, is just one of their higher margin, higher growth areas of the company, Clover, had, I think they were guiding for like 13% growth moving forward, and then during the most recent quarter, that guidance went down to like 8%. So,
but yet that's still
not bad, right?
By the way, I think Clover's still their growth engine, Nick, that you mentioned. And I think that's where they're going to get their most growth going forward from here. So the point is, something spooked the market, but I also want to point out the stock was, in my view, ridiculously overvalued, even as good. Again, it's one of my favorite stocks in the world. I've owned it off and on for decades, I guess you'd say. So this is a phenomenal company. It's finally cheap. But here's the point. You've got to be willing to commit. I believe all investing implies long-term investing. You guys agree?
Yeah, agreed. Yep.
Yeah.
Yeah. So the point is, as a long-term investor here, let me go back to the historical chart. As a long-term investor, you got to be willing to say, if the stock drops further, as long as these fundamentals continue to hold up, it would be something you would want to be adding to. They don't ring a bell at the bottom of the market. They don't ring a bell at the top of the market. This is about as cheap as the stock has been in 10 years, as you pointed out, Nick. And so, such a high quality company. It's great, but there is the whole industry, notwithstanding MasterCard and Visa, most of these stocks in this industry have been under pressure recently. And yet this is one of the creme de la creme of the group. It's got strong fundamentals, great growth. It's still got a great future. But if the market's spooked, emotions determine market price in the short run. That's the evil twin sister to earnings determine market price in the long run. So, this would be a great time to be building a position, in my opinion. And I am, by the way. I'm starting to look at it for my total return clients in my money management firm. It's what I've waited for a long time. I've got several that are starting to show up like that. Even on the dividend side, you got names like Pepsi coming into value and, a lot of other names like that. So the market's finally going through a correction process, and, being able to pick up great businesses at attractive valuations has been something I've been suffering with now for about 5 or 6 years. But I like Fiserv a lot.
Awesome. Well, that's great. So, I think we're about kind of halfway through our allotted time here, Brad. So I'll be quiet now and let you pass some names to Mr. Valuation here and see what he has to say about a couple of your favorite stocks.
Great. Well, the next two, of course, are going to be dividend stocks, and I got to go back and just say something, Chuck. I'm kind of in the same camp as you. I'm a dividend investor. I love income, but one of the great things about Wide Moat Research is that we cover a very broad universe of stocks, and Nick does a great job on both the income side as well as the growth side. And of course, it's not an either or, selection process, right? I think most investors like owning some growth stocks and they like owning some income stocks. And so I'm going to focus now on two income stocks. And, Chuck, you said earlier, you're talking about share buybacks. And I remember a couple of years ago, I was talking with the CEO, and his shares were really beaten down. The company was really cheap. And actually, Berkshire Hathaway ended up buying a position in this particular company. Yep. They're called Store Capital. Yep. They're now a private company. But I remember having that conversation with the CEO at the time, Chris Volk. And we were talking about share buybacks. And he said, share buybacks are good, but it's like one lever that we can pull. And it's kind of like, you have like one opportunity, to pull that lever. And you got to be careful, when the timing to pull that lever. Now, that's what he said. That's his theory of share buybacks. But Chuck, I would much prefer to have that dividend money than that share buyback. I'd rather have that capital return to investors. And of course, those last two companies that we talked about didn't have that opportunity. They don't pay dividends. So Now we're going to focus on two dividend stocks. Now, I love trains. I've always loved trains. In fact,
and this is what I've been worried about, Brad. But go ahead.
Yeah. So actually, I want to point out my daughter, Lauren Thomas, who writes for the Wall Street Journal. She wrote a breaking news story just a couple of weeks ago on the potential M&A deal between Union Pacific and Norfolk Southern. It was a great article. Lauren does a great job of kind of jumping into this M&A, and she's got great sourcing. Now, since that article was published, Norfolk Southern is up about 10%, and that was just a couple of weeks ago. I think July the 17th. Union Pacific is down about 3%, and Canadian Pacific is down 6%. So I'm just curious, what are your thoughts on Canadian Pacific? I know they did a merger with Kansas City Southern back in 2023.
Yes. Right.
So what are your thoughts on the train sector, but also Canadian Pacific?
Well, if you look at the company, just pure fundamentals again, Brad, it's got the gold line on this graph is dividends. Okay, they have a very low payout ratio, which is a good thing. Okay, they have they don't have much of a dividend. They're only less than a 1% dividend, but they've got good dividend growth going forward. They've had years where they've frozen the dividend. But the thing, I like about it is a very consistent company with consistent earnings growth. But once again, my friend, I hate to, don't want you to shoot the messenger, but I just don't like the valuation. I like this company at a 15 PE. I like it very much. Now, the merger and everything has kind of reinvigorated growth a little, if you can see where my mouse is moving here. Okay, so we've gotten some decent growth going forward. But if we're looking at it from a forecasting point of view, we've got double-digit 13% growth. That's awesome. The company's triple B plus, has real moderate debt. But again, I'd want to buy this stock cheaper if I was putting my money, because you're taking the risk. If you look at it from a historical precedence, every time it's gotten too far above this orange line, it reverts either back to it or close. And since it's been this high, if you go from peaks, this is a time where the stock hasn't really generated a giant rate of return. But I think the only culprit here, not the company, not the quality of the company. I like trains too. Okay, I like the industry. Warren Buffett's a major player here, obviously. But I think the only thing I don't like is the valuation. And I want you also to notice, when you see a stock that gets highly valued like this, it tends to, we got an earnings yield of under 5% currently. And up here, we had an earnings yield of, probably 3.5%, 3.5%. And that's just not enough return for me to take the chance. Now, looking for an opportunity for this stock to revert to the mean in the future, and sometimes you got to be patient. That's what I think you got to do. So my only, gripe about this company right now is it's got great growth. It's a great company. I read your daughter's article, by the way. It was a great article on the other trades. This is a investment grade, just short of an A-rated company, has very modest debt. I just don't like the valuation as much as, for me. Now, again, I'm Mr. Valuation. You've got to really get good valuation to me. Now, looking at fiscal fitness and looking at things like margins and so on, the margins are holding up, but their net margin has been dropping for 3 years or 2 years, whichever way you want to count that. And it's still pretty high margin, okay? But, is that something to be alarmed with? I don't know. But I just don't like the current valuation. I think it's too expensive, at multiples up here of 20, and I don't know if you guys, how much about the blended PE, but the blended PE, no PE ratio is ever accurate. It's either trailing 12 months or it's forward earnings. All right? They're guessing about what earnings are. What we do is we use the last actual, and then and what we try to do is go in between, the earnings in 2024, where there's no E there, was 425. We're expecting 476. So the company's been operating now for, 6 or 7 months. What level of earnings are they operating at today? And so we're using a number that's probably probably halfway between 425 and 476. That's what the blended PE is. Now, it's wrong, just like trailing 12 months is wrong, and just like forward earnings are wrong, because we just don't know we never know what the earnings are. Even when a company reports earnings, they report it 45 days after the quarter ends. And so you're already looking at a number that's half a quarter stale, if you will. But it's our job as analysts and investors to try to forecast something. Okay. So I think this company's got really good earnings growth ahead of it. I agree with the analysts. I just think the stock is vulnerable. I think you're taking a lot of risk buying it here. It's not a high yielding stock. Now I'm going to do you a favor, okay? And I'm going to go right into the next one and talk about, because I'm sure you're going to talk about Realty Income next. All right,
Chuck, I have to talk about Realty Income. You and I have
this
actually
is exactly the opposite story. But go ahead. I'm sorry, Brad.
Chuck, it's been great because for years, probably 15 years now, we have been debating Realty Income in a lot of ways. I think we both can agree they've got very solid fundamentals, which you could point out. But valuation has always been something that you and I have always, I won't say debated. Sometimes we've agreed, but I'm very curious now, kind of what your thoughts are on valuation.
I've been buying it like crazy in my income. So for a disclosure, I'm very long Realty Income right now. This is the first time since the recession of 08 that I've liked it. Now I liked it here. I liked it pretty good here. I liked it coming into COVID, or, at the end, at the throes of COVID. But one thing you can do with FastGraphs, Brad, like when you look at a real high valuation like this, now this is the same company, weren't missing a beat with their earnings growth. You're one of the great real estate investment trusts, the monthly income company, great properties. We won't debate any of that because it's all true. Okay. But if you'd have bought this stock, for example, in August of 2016, and then went through this reversion, you'd be making 2.5%. But if you'd have bought the stock, on the other hand, when valuation was reasonably sensible. And even though it's undervalued today, now your rate of return is over 7%. Valuation matters, and it matters a lot, because no matter what, if you look at even this great company, it's the market's put a premium valuation of about 17. This is times price to AFFO, to adjusted funds from operations. FastGraphs immediately, this is not earnings. And, we know the rules. You can know them better than I do. They got to pay out 90% of their distributable income. And that's why their payout ratio looks real high on this graph. But this stock is cheap now. We've got a dividend yield of almost, 5.6%, 5.58%. For a real estate investment trust, I think it has extremely manageable debt. And, they continue to just pay those monthly dividends, and they continue to grow those monthly dividends. In fact, one of the things I really like about this, we go into the performance graph here, that I really like about Realty Income is they've increased their dividend at about a 5%, right, 4.8%, average growth rate, compound average of 4.6%. If you're looking at a high yield investment like this, and you can expect 5% dividend growth, every year going forward, I don't see how you can turn this down. But this is an income vehicle. This is not a stock to make you rich. Fiserv is a type of stock that can make you rich if you buy it cheap enough. This is a stock to give you an extremely predictable, reliable, and consistent level of income. And I run two kinds of portfolios. I have clients that look for total return, and I have, they're younger that are, looking to retire in 10 or 15 or 20 years. And I have clients that are retired and are living off their portfolios. Well, this is in their portfolios. People right now that are, letting their money work as hard for them as they worked for it over all their lifetime. And they're getting a 6% yield that's growing at 5% a year. And they have a very nice opportunity here, because this has been primarily an income vehicle, but now you're looking at a stock that could, easily turn into a reasonably attractive capital gain opportunity, generating a 16, 17, 18% annualized rate of return, including dividends over the next 3 to 5 years. If there was ever a time to buy realty, you and I aren't going to argue about it anymore, my friend. Now's the time to buy it. Okay?
Yeah, I agree. And of course, over the years, we've seen the evolution of the company, and they've moved to an A-rated balance sheet, much more diversified sources of revenue, 15,000 properties around the globe. So definitely, I think in terms of the stability and really sustainability of that income and that dividend, it's much better today. It's definitely a much more defensive REIT than you and I talked about 10 years ago.
Well, again, it's the only time we argued is when you had these even if you're buying this at a 17 multiple, I wouldn't have argued with you, because most of the time, if you owned this at a 17 multiple, you could have generated, 9 or 10% rates of return. Now, right. This is fears of interest rates and so on. You know more about the real estate market than I do. But all of a sudden, we've got this stock trade. But I also want you to notice, look how often it dips down and gets back, dips down and gets back. This is any of these, I'm a buyer here, by the way. I want to be clear. I'm willing to buy it there. I'm a real motivated buyer, at these kinds of valuations.
Right. Well, of course, REITs have traded off over the last 2 years or so. And one of the things that we think is really compelling about this particular company, as well as many other REITs that we recommend at Wide Moat, is their cost of capital. I mean, this is a spread investing business. So I think when we finally get this interest rate cut, which I think I'm curious, Chuck, we'll kind of close at this. I always like to get what do you think about rates? I know you don't have the crystal ball, but what are your thoughts on Powell and the potential for rate cuts here this year?
Well, one thing I'm not going to do is get political, but one of my favorite Warren Buffett quotes, and I can only paraphrase it now. I wish I'd have queued it up, but he did it, I think, in a 1964 or 74 letter to shareholders. And I'll paraphrase. He said, we'll continue to ignore political and economic forecasts. And he summarized it by saying, which turned out to be nothing but a distraction for businessmen. If we identify a great business that we like and we like the value, then we're going to invest. So all of the things you're talking about, or you're bringing up, rather, I should say, are always going to be temporary in nature. It comes down to, these guys have good real estate. They have, great rents on those real estates. They're an acquisition company. They're going to be buying more real estate, and And when you can buy the stock this cheap with the growth, so any of those temporary things that could happen are things that you really have to ignore, because Ben Graham also said he said 35 years ago nobody could have foreseen the interest rates going from whatever to whatever, the dissolution of a president or something. I can't remember the whole quote, but he said, surprise, surprise, none of these catastrophic events, made any difference in the investment principles that Ben Graham taught him. And that is, buy great businesses at great values and hold them for the long run. And again, I do want to emphasize, I think this stock is probably at lows. I don't see real estate income getting much lower. Fiserv could dip lower in sentiment, not necessarily not on fundamentals, but on sentiment. And so my point would be, be an aggressive buyer here. If it gets cheaper, buy more, as long as we keep seeing that orange line proceed like we're seeing it. And again, this is stability with high income with growth, in my opinion.
Well, Chuck, I'm so happy to hear you say that, because Brad and I, about Realty Income in particular, because we've been, Brad, he's been pounding the table on this one ever since the interest rates kind of hurt the sentiment. I write a high conviction notice to our subscribers at the Wide Moat letter once a month. And I think, I'm sure they're getting tired of hearing me, write the word Realty Income in that notice. But like you said, I haven't seen the stock this cheap. I haven't been following it for as long as Brad, but this is exactly why we keep harping on this company. Some people say, hey, you guys talk about the same REITs every week. Well, because this is you could call this a generational buying opportunity when it comes to Realty Income.
There's the current valuation. Look, how many times have you had an opportunity to buy it at this price? Only in the Great Recession could you have bought it cheaper. And COVID, again, you could have bought it for about a minute cheaper. But otherwise, but beware of these peaks, because these peaks have nothing to do with Realty Income. They have nothing to do with the company. They have nothing to do with the management. They have everything to do with hype and hysteria. People will get excited for whatever reason, and and that's very dangerous. And you can look at so many stocks out there that that are trading at these nosebleed valuations today. And you're seeing stock after stock after stock. You're seeing the earnings collapse and not the earnings collapse, the price collapse on really nothing happening to the company's earnings. High valuation is risky. That's the point. Guys, this has been a pleasure. I don't know if I've overstepped my time here, but good to see both
Chuck,
of you again. Good to talk to both of you again.
Yeah, no, we appreciate your time. And no, you can, we want to have you back on the show again. I mean, this has been very, very helpful, and I'm sure our audience really appreciates your time. So thank you, Chuck. And we look forward to seeing you next time. And by the way, you can find Chuck at FastGraphs.com. So that's where we utilize a lot of our research here at Wide Moat Research. And Chuck, look forward to seeing you again back here soon.
I'm looking forward to it myself, guys. Great to see you both.
Thank you, Chuck. And guys, we'll see you next Thursday. Appreciate you stopping by.
All right, good deal.